G'day legends! Welcome back to the Gold Jumper channel where we keep a sharp eye on the shiny stuff. Jump up and under, let's get into it, because the last 3 days have been a total absolute ripper. Today we are recapping the massive oil price shock and why the energy markets are sweating bullets right now. We are diving into the Reserve Bank of Australia's shock rate hike and how the Aussie dollar is holding. Plus we will look at gold's battle to stay above $5,000 while the charts show a massive squeeze. Quick disclaimer for the lawyers, this is just for fun and education, not your official financial advice, fair dinkum. The big question for today is, will gold hit $6,000 before the winter kicks in down under? Let us know your thoughts in the comments below, and don't forget to like and subscribe to the channel. First up, the breaking news from the Middle East has sent the whole energy market into a proper spin. The Strait of Hormuz is practically closed, and that has blocked about 20% of the world's oil. West Texas intermediate crude oil prices have been jumping around like a kangaroo on a hot tin roof lately. On Monday, March 16th, oil prices actually took a dip of 4.70% to $92. But then on Tuesday, March 17th, prices surged back up to $96.73 per barrel. This volatility is enough to give any trader a grey hair, especially with the OVX index going wild. The RBA Crude Oil Volatility Index, or OVX, has been sitting at an extreme level above 100. That means the market is expecting daily price swings of up to 4.5% for crude. It is a high-stakes game for anyone holding energy stocks, as the geopolitical risk stays at a boiling point. Even with a massive strategic reserve release, the supply gap is making everyone in the pits very nervous. Now let's talk about home soil, because the Reserve Bank of Australia just pulled a sneaky one on us. On Tuesday, March 17th, the RBA hiked the official cash rate by 25 basis points to 4.10%. It was a real nail-biter, with a 5-4 split vote among the board members deciding our fate. Governor Bullock mentioned that inflation is still far too sticky and the energy shock is making things worse. This rate hike is the first one we have seen in a while, and it really caught some traders off guard. The board is worried that higher fuel prices will keep inflation above the target for longer than we hoped. They are keeping a hawkish bias, which means more hikes could be coming if the data doesn't cool down. It is a tough break for households, but the RBA says they have to act to stop prices from spiraling. Traders were pricing in a hold, so this move has sent shockwaves through the local fixed income markets. We are now looking at a potential cash rate of 4.60% by the end of the year. This RBA drama had the Australian dollar wobbling more than a loose wheel on a dusty outback track. The Aussie dollar was remarkably resilient, but it turned very choppy near the 0.70 level. After the hike, the Aussie dollar tested above 0.7090 before giving back some gains. On the weekly chart, we are seeing a shooting star pattern which suggests the recent rally might be over. Over at the ASX, the benchmark index had a shocker on Monday, March 16th, falling below a key level. The ASX 200 closed at 8,583, its lowest finish for the whole year. Mining stocks took a massive hit, with materials plunging over 2% as diesel and power costs surged. Gold miners like Regis Resources and Bellevue Gold were sold off hard as the liquidity trade took over. Energy stocks were the only winners on the board, gaining about 0.5% thanks to higher oil. It is a defensive rotation for sure, with legends moving money into banks and staples to hide from the chaos. While we are dealing with local rates, there is a massive shift happening in the global monetary system. The BRICS nations are pilot testing a new gold-backed settlement tool called the unit right now. This is a massive move toward de-dollarization, intended to bypass the Western banking systems entirely for trade. The unit is backed by 40% physical gold and 60% by a basket of local currencies. This means nations like Russia and China are using gold as an active trade asset, not just for storage. The US dollar index, or DXY, hit a 10-month high of 100.22 this week. But the BRICS pilot is designed to reduce the need for greenbacks when buying oil and grain. Gold is reclaiming its throne as the neutral asset that cannot be weaponized by any single government. Every time the US freezes funds, more countries look at the unit as a way to protect their wealth. This structural demand is creating a solid floor for bullion that the paper markets just can't ignore. Speaking of bullion, the price action from March 16th to March 18th has been a proper scrap. On Monday, gold opened at $5,010 and faced some heavy selling pressure from paper traders. It dipped to a low of 4,967 before the legends stepped in to buy. By Tuesday, March 17th, we saw a recovery high of $5,044 an ounce. Today, Wednesday, March 18th, we are hovering right around the $5,001 mark. Don't sweat the dip, just more room in the pouch, because 5,000 is a massive psychological floor. The US Federal Reserve is meeting right now, and everyone is waiting for the interest rate decision. If the Fed signals they are keeping rates high, gold might test the lows again before a big bounce. But if they show any worry about growth, we could see a massive relief rally back toward the highs. For now, gold is holding steady while the rest of the market is losing its absolute mind over oil. Even the rowdy legends over at Wall Street Bets are on high alert watching the metals traders this week. Sentiment on the forums is split, with some traders looking to short the move back to 4,000. They are setting short limits at $5,037 with targets down near the bottom. But the smart money is quietly flowing into gold as a hedge against the Fed's chokehold on liquidity. Some traders are calling the recent drops a bear trap designed to shake out the weak hands early. They remember the fake drop to 4,400 and they are not falling for it this time. Volatility is off the charts and the forum is buzzing with talk about a massive mother of all crashes. Most traders agree that if gold stays above 5,000, the real move is going to be straight up. Now, let's crack open the charts and look at the technical indicators for the 1-hour time frame. On the 1-hour chart, gold has been stuck in a unilateral downtrend since late last week. The price is consistently trading below the medium-term moving average, which is acting as a heavy ceiling. The Relative Strength Index, or RSI, on the 1-hour is sitting at 41.74 right now. This puts us in the neutral to bearish zone, meaning the bulls are still struggling to find their feet. The Bollinger Bands are narrowing on this short time frame, which usually means a breakout is coming soon. We are seeing a bit of a rebound from the lows, but the RSI hasn't crossed 50 yet. The MACD signal is still below the zero line, showing that selling pressure is still the boss. If we can break above 5,140, we might see a staged rebound higher. But for now, the short-term structure is looking a bit weak and needs a fresh spark to ignite. Traders are waiting for the US session to see if the volume picks up and pushes us through. Watch that 41 RSI level closely, because a move lower would confirm the bearish bias for today. Moving on to the 4-hour chart, things get a bit more interesting for all you legends watching. We have formed what looks like a triple bottom pattern right around the 4,900 zone. This is a very bullish signal if it holds, suggesting that institutional buyers are loading up the truck. The RSI on the 4-hour chart is currently reading 38.38, which is quite soft. It is not quite oversold yet, so there might be a little more room to slide before the bounce. The parabolic SAR dots are sitting above the price candles, which signals continued downward pressure. The MACD is showing fading bullish momentum, mirroring the struggle we see on the shorter time frames. Resistance is sitting firm at $5,250, where the upper Bollinger Band sits. If the bulls can reclaim that level, we are looking at a clear path back to the all-time high. Until then, we are range-bound between $5,000 and $5,250. Volume is healthy, but we are not in full breakout mode just yet, so patience is the name of the game. Keep an eye on those red candles, because they show the bears are still trying to push their luck. Finally, let's look at the daily chart, where the big picture for 2026 is really forming. We are currently in a massive Bollinger squeeze centered right around the $5,000 level. The price is oscillating almost exactly at the 20-day simple moving average of $5,009. Historically, these squeezes lead to an explosive move once the price breaks out of the narrow range. The daily RSI is sitting at 46.93, which is a very neutral reading for the metal. The most exciting bit is the golden cross that recently flashed on the charts as a reversal signal. This happens when the short-term moving average crosses above the long-term trend line, showing bullish momentum. Even though it is a lagging indicator, it confirms that the long-term bull market is still very much alive. The 50-day moving average is sitting at $5,008, acting as a secondary floor. Meanwhile, the 200-day moving average is way down at $4,047. This shows just how much gold has run up over the last year, gaining 16% in 2026. A daily close above 5,160 would signal that this consolidation phase is finished. But if we fail to hold the floor, we could see a quick slide toward the 4,700 mark. The MACD on the daily is slightly negative, which is a tactical sell signal for the short-term swing traders. But as long as we stay above those major moving averages, the primary trend remains unambiguously up. The Golden Cross is the anchor for our bullish thesis despite all the noise from the oil markets. We are essentially waiting for the market to digest the blow-off top we saw back in late January. This sideways grind is actually healthy as it resets the positioning for the next leg towards 6,000. To recap the technicals, the 1-hour and 4-hour charts are showing some short-term bearishness and struggle. But the daily chart is flashing a golden cross and a Bollinger Squeeze that suggests a boom is coming. Don't let the short-term wiggles scare you off your long-term goals because the structure is solid. The $5,000 level is the line in the sand that the bulls are defending with everything they've got. If the Fed gives us a dovish surprise tonight, that squeeze will pop to the upside very quickly. Otherwise, we might just chop around a bit longer while the geopolitical fire continues to burn. So to sum it all up, the global energy shock from the Hormuz closure is keeping inflation risks high. The RBA has shocked us with a hike to 4.10% to fight that sticky inflation. The ASX and the Aussie Dollar have been taking hits as the market reprices the risk of a stagflation outcome. De-dollarization is accelerating with the BRICS pilot of the unit backed by physical gold reserves. Gold is holding the $5,000 floor despite paper traders flushing their positions for quick cash. Technically, we are in a massive squeeze on the daily chart with a golden cross supporting the bulls. The next 48 hours with the Fed will be the decider for whether we break out or consolidate more. Now I want to hear from you legends. Do you think the RBA hike will kill the local gold rally? Drop your price predictions for the end of March in the comments, and let's see who gets it right. Hit that like button if you found this helpful and subscribe so you never miss a jump on the charts. Stay active, stay legendary, catch ya.